Welcome back to Investing Talk Podcast.
Good to be back.
Today we're taking a closer look, using a few different sources we've got here, an analysis report, a due diligence breakdown, and the recent May 2025 financial update to really unpack the cybersecurity company Intrusion. That's INTZ.
Right.
Our goal is pretty straightforward. Get you up to speed quickly on their performance, their financial situation, and what might be next based on what these sources are telling us.
That sounds like a good plan. Intrusion, at its heart, is in that really critical cybersecurity space, protecting data, fighting threats.
And the sources seem to emphasize their tech, things like threat intelligence, zero trust.
They do. The sources point out they're leveraging some advanced tech, especially their big threat intelligence database. Zero trust solutions are a key part of their offering.
Okay, so before we get into the numbers and outlook, what exactly is their core business? What are the main products the sources mention?
Well, the core idea is using that tech, especially the threat database, to spot and stop threats before they do damage. Proactive stuff.
Makes sense.
The sources highlight two main products. There's Intrusion Shield, that's their zero trust, software as a service product, reputation-based.
Okay, Shield.
And then there's Intrusion TraceCop, described as more of a big data tool for forensic investigation after something's happened.
Got it. So Shield for prevention, TraceCop for investigation, both using that database.
That seems to be the picture from the sources.
All right. Given that focus on advanced tech, how's the market actually been viewing them? The sources definitely flag some significant stock volatility.
Oh, absolutely. Volatility is a big theme. If you look at the 52-week range mentioned, it's huge.
Yeah.
$74.50 on the low end, up to $7.340 on the high end.
Wow, that's quite a spread. What about more recently?
More recently, like the past month, the sources put the movement between $1.5550 and $1.740, sort of hovering around, say, $1.59 to $1.74 in late May.
Okay, tighter range lately, but still, that big picture volatility is there. And the sources mentioned a downward trend over the last 6 months or so.
They did. They link that general decline from earlier highs partly to challenges in the broader cybersecurity sector, maybe wider market issues too.
Standard headwinds, perhaps?
Possibly. But there was this interesting moment, mentioned an intraday spike back in mid-March, over 22%.
A 22% jump in one day. Do the sources give any clues why?
Not definitively. The speculation in the material points towards maybe anticipation around earnings or perhaps some contract news around that time, just possibilities mentioned.
Interesting. But apart from that spike, generally quieter compared to the big indices.
That seems to be the takeaway, yeah. Relatively subdued since then.
Okay, so the market's showing that uncertainty. Let's dig into the financials behind it. What do the trailing 12 months, the TTM figures, look like, according to these sources?
For the TTM period, the sources report revenue at $6.42 million.
Okay.
But net income is negative, a loss of $8.17 million.
Which translates to earnings per share of?
An EPS of negative $0.93.
Right, a significant loss. Now, is that kind of loss unusual for a company like this, investing heavily in R&D for cybersecurity?
The sources actually address that. They point out that operational losses aren't uncommon in the sector precisely because of that heavy R&D spend. Staying ahead of threats costs money.
Constant innovation needed.
Exactly. Building that cutting-edge tech often means profitability takes a back seat, at least for a while.
That context helps frame it.
Yeah.
Now let's zoom right in. The most recent data is Q1 2025. What did the sources say about that quarter?
Okay, Q1 2025. Revenue came in at $1.8 million.
And the trend there?
The trend is positive on the top line. That $1.8 million is up 57% compared to Q1 last year.
57% year over year. That's strong.
And it was also up 6% from the previous quarter, Q4 2024. The sources make a point that this is their fourth consecutive quarter showing revenue growth.
4 straight quarters of growth is definitely notable. But what about the bottom line? Did the loss shrink in Q1?
Actually, no. The net loss reported for Q1 2025 was $2.1 million. That's wider than the $1.7 million loss they had in Q1 of 2024.
So revenue up, but loss is growing year over year. How does the EPS look?
EPS was negative $0.11.
Yeah.
That's the same as Q4 2024, and a little better than the negative $0.12 in Q3 2024. So sequential stability or slight improvement on EPS, but the year-over-year loss widened.
Okay, this is where it gets really interesting, though, because the sources talk about some major strategic moves they made in Q1 regarding the balance sheet.
This is probably the biggest news from the recent update, yes. They essentially undertook a major cleanup of their balance sheet in Q1.
How they do that? It mentions generating cash.
They brought in $14.5 million in proceeds. This came through several different kinds of transactions mentioned in the sources.
Like what kinds of transactions?
Yeah.
That's a bit complex.
It involved things like a warrant inducement, encouraging people to exercise warrants, a standby equity purchase agreement, selling stock through an ATM program, also a registered direct offering. Basically, different mechanisms to raise cash by issuing equity or related instruments.
Okay, so they pulled in cash through these stock-related deals. What was the purpose? What did they use it for?
This is the crucial part. They use that cash and the structure of some deals to dramatically reduce their obligations. They retired all their remaining Series A preferred stock that was about $10.1 million worth.
All preferred stock gone.
And, perhaps most importantly, they eliminated all their remaining debt.
Wait, all debt? How?
By exchanging it for common stock, according to the sources, so debt converted to equity.
That's a massive change to their financial structure. No debt left. So after all that, what was their cash position at the end of Q1?
The sources state they ended the quarter with $10.7 million in cash and cash equivalents.
$10.7 million. And how did management, like the CEO Tony Scott, talk about these moves?
The commentary highlighted in the sources frames these as deliberate strategic actions. The goal was explicitly to strengthen the balance sheet, clean things up, and position them better for growth.
Makes sense strategically. Does that $10.7 million give them breathing room? How long does the cash last?
The sources suggest it's enough to fund operations into 2026. Importantly, they state no additional capital should be needed this year in 2025.
Okay, that really changes the context for the Q1 loss widening, doesn't it? They secured their financial footing significantly.
It seems so. They tackled the debt and secured a runway.
All right, let's try to summarize then. Based on all this, what are the key strengths and the key red flags that jump out from the sources?
Strength-wise, the sources consistently point to the innovative tech. That AI-driven threat detection capability is seen as a real asset.
Right.
And there's strong growth potential mentioned, tied to market demand, especially government interest. That recent U.S. Department of Defense contract for SHIELD and consulting, that's highlighted as key validation.
Government contracts are often seen as stable anchors.
Exactly. Now, on the flip side, the red flags.
The concerns.
Well, the ongoing losses are still there, and the fact the loss widened year over year in Q1 is noted. The stock volatility we talked about, high operating expenses are also flagged $3.4 million in Q1 alone.
OpEx is high. Anything else?
Yeah, some pressure on gross margin. It apparently dipped from around 80% down closer to 76%.
Okay, so slightly less profit kept from each sale before other costs.
That's the idea. And finally, the sources mention a potential risk of shareholder dilution. This stems from those past deals, converting debt into equity to clean up the balance sheet.
Right, the trade-off. Fixing the debt meant issuing more shares. Common situation. Okay, shifting focus a bit. What's the general feeling or sentiment out there? What do analysts say according to the sources?
Well, there's one specific analyst view presented that's quite bullish. It's a buy recommendation with a 12-month price target of $6.25.
$6.25. That's quite a jump from where it's trading now. Over 280% potential upside suggested there.
It is very optimistic, yes. But the sources do caution that this is one perspective.
Are there contrasting views mentioned?
Yes, the sources acknowledge that opinions vary. Public sentiment on forums and such can be different, and they specifically call out algorithmic forecasts as being highly speculative. Some models apparently show huge upside, like $14 or $15, while others predict long-term declines below current levels.
So a real mix of signals. High analyst target, but also speculative forecasts going both ways. Anything else on sentiment, like social media buzz or trading activity?
The sources note a lack of significant recent trending discussion on social platforms or any unusual trading volume or major analyst coverage changes being reported lately on the main financial news outlets. Kind of quiet on that front, it seems.
Okay, so analyst optimism exists, but it's not necessarily matched by broad market excitement or consensus right now.
Yeah.
How does Intrusion fit into the bigger picture competitively? Who are they up against?
The sources clearly position them as a challenger, a smaller player going up against the giants in cybersecurity.
Like who?
Think Palo Alto Networks, CrowdStrike, those kinds of established large-cap companies.
Big competition. So how do the sources suggest Intrusion tries to stand out?
It comes back to their specific tech, that AI-driven approach for threat detection. That's their differentiator, according to the material. But, the challenge is obvious, competing against companies with way more market share, much deeper pockets, more resources overall.
And those big competitors, are they also benefiting from things like more government spending on cybersecurity?
Yes, the sources confirm that. While increased federal spending is good news for Intrusion, it also helps the big players who already have established relationships and contracts there. It lists multiple boats.
Right. So looking forward now, what potential catalysts, risks, and opportunities do the sources identify for Intrusion?
For catalysts, things that could move the needle positively, future earnings reports are key, especially if they show not just continued revenue growth, but also real progress on managing those losses, improving profitability,
Better bottom line results.
or announcing significant new contracts. Product improvements, especially around their AI tech, are also mentioned as potential drivers.
And the risks, mostly things we've already touched on.
Pretty much, yeah. The sources reiterate risks like regulatory changes, especially around data privacy, broader market downturns or sector-specific challenges, the ongoing profitability concerns tied to those high operating expenses, the gross margin pressure, and that shareholder dilution risk from the past debt conversions is mentioned again as something to keep in mind.
Okay. What about opportunities? Beyond just improving current operations.
Well, landing more government contracts like that DoD deal is seen as a big opportunity, brings validation and stable revenue. The strengthened financial position itself is a major, plus that $10.7 million cash, no debt, that gives them flexibility.
Right, the clean balance sheet.
And the sources also mention specific initiatives like preparing to launch on the AWS marketplace, which could open up significant new sales channels.
Okay, let's try to connect the dots here. Why is this deep dive into these particular sources useful for you, the listener, trying to understand Intrusion?
Well, because it paints a really nuanced picture, doesn't it? You have this company with genuinely innovative technology in a high-demand market, that they're getting validation through things like government contracts, and there's some analyst optimism.
Right.
But that's balanced against these very real financial challenges, the continuing operational losses, the high costs, the margin pressure, and crucially, understanding those big balance sheet moves they just made, getting rid of the debt, securing that cash runway that's vital context.
They've taken decisive steps to improve stability.
Right. They've bought themselves time and flexibility. The next big challenge, clearly highlighted, is turning that revenue growth into actual profit.
So looking at these sources helps you see beyond maybe just the stock price swings or the simple revenue number. You understand the strategic rationale, the resources they have now, the specific hurdles, and why different people might interpret their prospects differently based on these details.
That's it, exactly. It's about getting that deeper understanding that the sources provide.
Which brings us to a final thought to leave you with, building on this material. Given Intrusion's recent success in eliminating debt and securing a cash runway, while still facing operational losses, how might their strategic focus on government contracts influence their path to sustainable profitability compared to companies focused purely on the broader commercial market?
Something to consider. We hope this look into the sources on Intrusion has been helpful for you.
Let us know what you think and what other topics you'd like us to unpack. Please do subscribe, like, and comment.